What a fascinating 2024 election we've had. It looks like President Trump will be the only second president in history to win a second term that's not consecutive after President Cleveland. It also looks like the Republicans will recapture a majority in the Senate, and the House may be a very, very fine margin either way. But what markets will effectively do is discount effectively a red clean sweep, a Republican clean sweep. Now, what are the implications for financial markets, but critically, what are the second order effects as well? So from a financial markets perspective, we're likely to see the reinvigoration of a US first industrial policy, a focus on a much more assertive trade policy, a focus on increasing exploration and production activity in energy, and then finally as well, a revisiting and a potential rolling over of tax cuts from the first Trump presidency, and also a rethink around government spending. So in terms of asset class implications, this is likely to be initially positive for US equities, in particular the discounting of a persistent lower tax environment for corporates, and potentially also some new tax cuts for middle income families and households as well. A stronger US dollar on the flip side will result in weakness in some of those critical cross currencies, in particular trading partners that the Trump presidency is likely to focus on. So the Mexican peso will weaken, the euro will potentially weaken, and there might be some pressure on the Chinese yuan as well. In addition to that, we're likely to see an initial knee-jerk sell-off in bond markets, but critically also a steepening of the yield curve. This is a reflection of the market discounting a higher potential growth outlook, but also a reflationary policy mix. Now, we do expect near-term weakness in bond markets, but given that the Trump presidency will also focus on trying to rein in certain parts of government spending, the budget deficits aren't necessarily likely to widen further versus a President Biden administration. So actually, we might see some emerging buying opportunities in bond markets after this initial bout of pressure. Now, what are the second order effects critically as well? If we focus on China, the NPC is critically meeting this week. We think this is going to result in an even bigger stimulus policy announcement from them. They recognise that there will likely be increases in tariffs in various industries as a result of Trump's attack on some of the asymmetric trading practices perceived in America. So the Chinese government will need to introduce greater spending packages in order to support domestic industry and domestic businesses as well. So that is likely to cushion some of the volatility that we might likely see in Hong Kong and China assets as a result of this policy response. The second order effect that I also want to focus on is what happens in terms of central banks continuing to cut interest rates around the world. Now, in Asia in particular, we've seen the Indonesian central bank, the Philippine central bank, and the Thai central bank cut interest rates recently. But with this renewed bout of US dollar strength, that may well give these central banks pause for thought. So we may actually see a pausing of further rate cuts in the immediate future in central banks outside of the US. The next final event to watch is the US Federal Reserve, which meets later this week. Markets currently anticipate a 25 basis point rate cut. That looks likely to prevail. But what the US Federal Reserve might do is try to defer a further rate cut, which was initially expected for December, because they'll wait to see what the new administration announces in terms of policy, in particular spending and tax policy. So we could see a further rate cut by the Fed this week, but a signal to the market that they're going to pause and wait for further information from the new government in the US.